Hello and welcome to Dell's Life, and this is the fourth part in the cryptocurrency series I'm doing, and in this particular video we're going to be looking at the mining of cryptocurrencies using ASIC and GPUs to generate cryptocurrency. What is meant by mining in the cryptocurrency environment? Well, for most coins, the mining process is part of the security of the cryptocurrency in that it is used to confirm the transactions that will be part of the block for the next that's added to the blockchain. Using mining, you decentralize the process to reduce the chance of any single point of failure or any single point being able to be hacked and otherwise taken over. So it provides security for your cryptocurrency. The process is quite convoluted mathematically, simple yet complex, if you see what I mean. It's a simple process that the miners take the transactions within a time frame which is based upon the block time, and they compete to find a hash that will confirm all of those transactions within the block. It's not immediately apparent what the hash will be, therefore they have to try lots and lots of hashes, and as new transactions come into the block in a blocked time period, the hash will change. So the hash is only relevant when the last transaction is given to the block and you have selected the correct hash. The winner, i.e. the person who submits to the central nodes the correct hash, is given a reward of a certain number of coins for that particular cryptocurrency. This is also a way that the more coins are created within the cryptocurrency, because these coins are new coins. They are fresh, never used before coins given specifically to that miner. So how do you mine cryptocurrency? First of all, you need a machine to calculate all of the hashes and to submit them to the central nodes. This can be a computer, just as you get in your desktop computer, or it can be a specialized equipment such as an ASIC, which is an application-specific integrated circuit. Every cryptocurrency has a mathematical algorithm that it uses to create and guess the hashes. There is lots of different algorithms, and each cryptocurrency may adjust the algorithm slightly to create a new one, or they use an existing algorithm that is known to be supported by either computers or ASICs. Over time, the cryptocurrencies may change algorithm or modify the algorithm over time for various reasons. So once a person has their computer or ASIC, they connect their system up to the network, and the miner starts getting transactions and starts working out the possible hashes using the specific algorithm. And if it finds a valid possibility, it submits that to the node for verification. The chances of an individual miner getting a correct hash is very small. There are millions or billions of millions of potential hashes every second on a cryptocurrency. No one machine is powerful enough in the time frame available to try all of the hashes to guess it immediately. So what happens is nodes will try ranges or random hashes to basically try and guess it. It's very much like a lottery system in that there's so many numbers, they guess a range of numbers, or they try and guess a load of numbers to see if they win the lottery. Once the successful hash has been created and submitted, it's added to the blockchain, and that secures the block for the blockchain, and they're ready to move on to the next block. So if this chance of finding the correct hash is so small, how can a miner have a chance of even getting the correct hash? The most common way is that miners group together into a pool. It's the equivalent of a consortium in a lottery. All of the miners in a pool share the testing of the possible hashes, and the pool hopefully has a intelligent system which basically divides all the possible hashes among the miners to try to reduce duplication of testing, so that the pool itself has a higher chance of guessing the correct hash. When you submit hashes to the pool, you are getting a share of the potential reward of the pool based upon how many hashes you submit. So the faster your machine, the more powerful, the more submitting you can do in a time frame, and the bigger the share you will get if the pool wins and submits the correct hash to the winning node. So when it does win, everybody gets a share of the large reward. If the pool doesn't find the correct hash in a time period, generally what happens is your shares are not lost, they are moved and carried forward into the next block and the next set of guesses and hashing. But this share is reduced over time. But it takes some time. Depends on the pool. There is different algorithms. There's some that immediately say, nope, immediately drop all shares, and there's some that take quite a long time. So sticking with a pool can be beneficial rather than pool switching. But we'll get into that into a different video on mining strategies. But generally, the more you hash into a pool, the more share you get of the reward. Also, basically, because the pool now has such a large group of miners producing so many hashes in a time frame, their chance of getting a reward, or the average time to get a reward, is higher. Although the chance of getting the correct hash is still somewhat based upon luck, because there are so many blocks created in a day or a time period, the chance of a hash is quite averaged out over time and is more a mathematical percentage chance than really being based upon pure luck like a lottery once a week or so. In some cases, blocks are being created every couple of seconds. So in a day, that's a lot of blocks, and if you've got enough hashes going through, you've got a good chance of getting one or more of those blocks. The more hashes that are going into the pool, it's just you're getting a higher distribution. You're not actually going to get, percentage-wise, any more blocks than another pool of equal hash rate. It just means you get a more regular payment into your system. There are different types of miner used in cryptocurrency for different reasons, and each have their own set of advantages and disadvantages. Most mining started with the basic computer using its CPU and its graphic card, its GPU, to run the various algorithms and start off the blockchain. The advantages of a computer system is it can run just about any algorithm, and it can easily switch between the different algorithms just by loading a different bit of software. And this can be done immediately. Very rarely does it need to have to be rebuilt or a major change, and it's easy to update. It's also created using standard components which are easy to purchase, and you have a wide choice of components to use. You're not limited to a small number of suppliers for your computer. Being a standard computer, the components have a residual resale value. They are usable by people who just want a computer in the future. So once you have finished mining with your equipment, you can resell it on the second-hand market for often 50% or so of your initial cost. Depends on the time, after 1 or 2 years, the systems are still quite a high quality of system and generally get a 50% return. You don't have to totally junk a system. Often you can just upgrade particular parts of a system to keep it current. So the GPU, for instance, the main suppliers normally come out with a new version every 2 to 4 years. Depends on, sometimes there's a large gap, sometimes there's a small gap, but 2 to 4 years, and that increase is about a 30% increase. So there is advantages for moving to a newer version of a GPU, but possibly only once the cost and the initial return on investment has reduced to make it actually profitable to move. This is generally used in medium to low return on investment systems, as the return on investment may be over a long term, but you have a residual value, so your actual return on investment isn't of the initial cost of the unit, but the long-term upgradability and residual value has to be taken into account on that unit to work out your true return on investment. An ASIC, or application-specific integrated circuit, is a machine which is purpose-built for a specific task. In this case, generally it is built to mine a specific algorithm, or even down to a specific coin, but generally they are designed to be highly efficient on a single algorithm. They will mine that algorithm at a very high rate compared to a GPU. They will be more power efficient and generate more hashes per second than the highest level of GPU. These ASIC machines are only available from a relatively few suppliers, and you have to deal directly with them or an agent, and delivery times can be, in some cases it's been months, but generally let's say a few weeks. It's not a system you can just go to a shop and buy a up-to-date ASIC miner. Some of the other problems with ASIC miners is if the algorithm that the miner has been created for is no longer profitable to mine, either because of new systems or the coins that are based on it have gone down so low in value they're no longer actually making money, your ASIC cannot be used for anything else. It is worthless. It has no second-hand retail value other than novelty or as a doorstop, and you can't generally upgrade it to make it or change it to a new algorithm. New ASIC miners are also released every few months, and the new miners can have a 50 to 100% efficiency increase compared to the previous version. This means that you need to have a very high return on investment on that ASIC miner to ensure you get the money back for that ASIC miner before the new release of a new version. If you are late getting your miner because of delivery times, or you just didn't get the absolute newest system, very often by the time you get your system and start it mining, it's no longer actually making money if there's now a newer system being created that has been sold or bought in bulk by another miner. Generally, ASICs are good for short-term, high return on investment rewards, but have a high risk. So with all of that taken into account, why do people mine cryptocurrencies? First off, there is a short-term profit people are looking for. So they will get the coins and convert them into their currency of choice quickly to pay for the electric usage for their miners, to pay for the equipment, buy new equipment, staff to look after the equipment. And this short-term gain is generally large mining sites that are using industrial ASICs, large racks of all of these ASICs or large GPU miners, and they're on a relatively low margin but a high investment over a short term, and they're expecting to renew all of their equipment very quickly. So there's a high turnover of equipment. You need a lot of money to get into that particular environment. The other type is supporting a coin. So a group might say they like a particular coin and they want to support it because they just want that one coin and they're holding it because they think that that coin will be much better in the future and gain in value, so they just want to get as much of that coin as they can. They also may be just supporting the coin's infrastructure by providing miners to secure that coin. So they may be developers or just have an intrinsic interest in that particular coin's success, so they will just mine the one coin. This is often done by ASICs or GPUs on a smaller scale, where they're not interested on the return on investment. They are just supporting the coin, either long-term future gain or just as support. So they're not really worried about upgrading or changing or manipulating the system to move to a different algorithm. Then you have the long-term investment, where people will mine the most profitable coin or algorithm, and they will switch as a new coin comes in, it's more profitable as the algorithms change. So they will look for the most profitable way to gain as many coins as possible. Those coins are then often converted from the mined coin into one of the major top cryptocurrencies. And then that currency is then held because they have a belief in the general cryptocurrency infrastructure, so they feel that there's going to be a good gain in the future, so they just want to get as much of that currency or coin as possible to hold it for future major gains. Or they want to use that coin to trade it into other coins and try to get better coins or other coins they do want to hold. So basically they're converting one coin into another for investment purposes and or trading. This type of mining is generally done by GPUs because they can switch algorithms very quickly and adapt to the changing environment without reinvesting money into the system. How can I start mining or get into this cryptocurrency? You have the industrial miners who have a large investment to put forward into mining, and they'll get a large secure warehouse, and they rely on cheap electricity in their area, and they will generally buy a lot of ASICs, which is a high initial investment, but go for a very quick turnaround on those ASICs to get a return on their investment and hopefully some profit. Industrial miners, when they're set up, they're noisy, very hot environment. You have very high electricity usage. You'll need full-time maintenance staff because ASICs do go wrong and need to be repaired or sent off or restarted. And the venture in general is a high risk, high reward. You are putting a lot of money down on invested infrastructure, and there is no guarantee that those ASICs will give a return on investment before they're superseded by a newer version of the ASIC. So there is a high risk there that you could have just spent all of this infrastructure money for no actual return. You have the hobby miner, who only needs a small room or office or small warehouse, not a large environment, and generally has some of these open frame GPU miners which have 6, 12, I think I've seen up to 19 GPUs in this miner. And they are a medium entry cost because of the number of GPUs of getting into mining. You generally need a certain level of IT knowledge and experience to build your miner and to keep moving it between the various currencies and algorithms to ensure that your system stays profitable. Also, if there's any problems in your 12 GPU miner, you need to be able to fix it quickly to ensure you're continuing to get profit. Otherwise, every hour that your 12 GPU miner is offline or down is lost profit. This is generally a knowledge-based risk-reward system, in that the more knowledge you have about IT and cryptocurrencies, the more reward you can get and the lower the risk. If you have very little IT knowledge, then repairing a big GPU miner could take some time, or relies on other people, or has an intrinsic cost for other people to fix your system. This is why I class it as the hobby miner, or people who have an IT knowledge that get into cryptocurrency mining. The final side is the consumer miner. They are only getting into mining in a smaller way, low risk, or they only want to invest a small amount of money, and they only have a small area in their house where they can put a miner with just some airflow. Often a standard PC case is used to house the GPU miner with 1 or 2 graphics cards, but otherwise is a standard PC and may even be used as a normal PC in the future. This generally has a low entry cost, as the cost is only for a couple of GPUs, not a large system. It has a good residual return in the future because it is using standard PC components in a standard case. It can be sold either as a PC itself or the individual components taken out and sold individually. It is for a long-term investment. The return on investment is lower than the other systems because it is a smaller scale mining and slightly less efficient than the open frame miner. But the residual value being as high or higher means that the total return on investment is at a similar rate. It also doesn't need as much IT support if you get it remotely supported for you, and doesn't necessarily need any specialized expertise to manage the system. It may be supported by the supplier of the unit, so minimal expertise required. It's also what I call animal and child friendly. If you're in an environment where you've either got pets, animals or children, you haven't got fans and electrical equipment open to people's paws, fingers, or just some animal landing on your GPU miner and, I wouldn't say totally destroying, but certainly causing some issues when they get into all the electrical components and open fans, etc. of a open system. These generally have a low risk but a steady return. You normally have these set up. They don't need much interference from yourself. They sit there as long as they are on and being remotely supported. They will give you a steady return on your investment, which you can then use to hold for future gain or trade, as we talked about previously. Next video I'm intending to look at trading cryptocurrencies. Once you've got all of your cryptocurrency from mining, or you've bought cryptocurrencies, what can you do to increase your cryptocurrency holdings, and what are the risks involved? If you've got any comments about this particular video, please leave them below. Please give a thumbs up if you think I am correct in what I'm saying, or you think you have got value from this video. But until next time, thank you for watching the video, and I hope to see you in the next video.